You have Robert Parker, Senior Advisor, Credit Suisse, joining us with a quick perspective on the global markets and also our local event in the credit policy. Robert, good to have you. What are your expectations from the RBI's credit policy today? Do you see status quo by the RBI, by the central bank, on interest rates?
I think for the moment, one probably has to see stability in RBI policy. Obviously, the key driver is the inflation rate. The inflation rate is stubbornly high. I would hope that as we get into the fourth quarter of this year, one could see the headline inflation rate coming down below 8%. That may allow some scope for the RBI to ease. Now, if you ask the question, where are interest rates going to be, over the next 1 to 2 years, the answer is lower. But I think to quantify that, taking a one-year view, probably only perhaps 1% lower than where we are today. And one has to recognise that India is one of the high interest rate economies, and that's against a background of structural inflation, which does need to be, well, I think we all agree, has to be addressed.
So do you expect Reserve Bank of India to remain hawkish, especially on the inflation front?
The answer to that is absolutely yes, and I think it would be wrong of the RBI, and I would be very surprised if they loosened up on their current attack on inflation. Ideally, one would like to see inflation down at 5% or less. Unfortunately, I don't think one's going to get that, but certainly the RBI is very much focused on preventing any further increase in inflation.
Do you see any possibility, Robert, for tweaking an SLR or the CRR by the RBI this time around? Do you think the RBI may choose to further cut SLR over the coming months?
Well, I think that's a very interesting question, because one debate amongst all central bankers is the question about whether interest rates are just too blunt a tool for managing an economy. And, should one use other monetary instruments, such as minimum reserve requirements for banks, lending directions to banks, and here, for example, in the UK, we have seen the Bank of England increasingly restrict mortgage lending to try and rein in what is an overinflated housing sector. And I think the RBI, along with other major central banks, will increasingly be focused on other measures such as these, with a view to keeping interest rates high, but try to encourage bank lending, particularly to the small and mid-sized enterprise sector.
So how do you see RBI managing the liquidity concerns, and what is your view on call rates? The 10-year yield, at least in India, trades at around 8.5%. So what is your take on the yield curve going forward?
For 10-year government bond yields, I think we are at or close to a peak. But are we going to get a very significant bond market rally? Well, I think the first point is that foreign factors are not conducive to a rally. If we have 10-year US Treasury yields, edging up towards 3% over the next 6 months. So, the international background is not conducive for a rally. Having said that, as I mentioned earlier on, India is one of those high-yield currencies and economies, and foreign investors and domestic investors, in an environment where inflation is edging down, I think will find 10-year yields attractive. By year-end, I think it is entirely possible to see the 10-year yield close to 8%. But are we going to see a sustained rally beyond that? I think not.
Well, what are the sectors that you like at this point or dislike respectively in India? Would there be any change in sector allocation, if at all?
Well, given my view on the global economy and my view that, at around 60, 61, the Indian rupee is fairly valued, I think the export sectors or the export-dominated sectors should do better than they have done over the last 2 years. I think another factor, of course, is that domestic demand is reasonably buoyant, and consequently the consumer sectors, I think, will do well. I think, finally, one has to take a negative view on any sectors which are vulnerable to the slow removal of subsidies. And I think it is subsidies aren't going to be removed in a dramatic knee-jerk reaction by the government, and I think the new government have made that very clear. But it is inevitable that to deal with that budget deficit problem over a period of years, subsidies have to be reduced. Sectors which are vulnerable to subsidy reduction clearly will underperform.